Jay, can you hear me? All right. I think you should have the screen right now on the microphone. Right now we can't hear you.
Can you hear me now? Test, test.
Yeah, now it's working fine. Yeah.
Okay, excellent. Good morning, traders. Good morning. Excellent. Glad to have you, Bob. All right, let's get going. Good morning, York. Risk disclaimer. We went through this. All right. Trade last week, cable. I was expecting a short, as we can see, and it's quite interesting here. Let's see if I can get a highlighter, laser pointer. Maybe you can see this better. Okay, so the market continued to drop off a little bit, then rebounded, and then came off again, didn't hit the target region. What's important to note here is that we call this a failed auction. The market showed signs of inherent strength, and then we were not able to drop below into this liquidity in the form of hidden liquidity stops, as well as in the form of liquidity in the book, i.e. institutional buy limit orders. A failed auction is a very, very weak sign. That means on the turnaround, you can see that the volume then increased as we headed towards the hidden and outright liquidity above this swing high. And the question is always, what do they do once they hit the liquidity? And in this case, they bought it. We had what we call a break, hook, and a go. So former resistance turns into support right here. Again, rising prices on increased volume means more activity towards higher prices. You were able to get a few pips out of this trade. It was Monday morning construction day, but this should have been your sign that the auction is failing and then there's inherent strength in the market. Sorry for my voice this morning, by the way. I don't know what's up. Okay, so that was that. Another trade that I had on the docket was short euro pound. Never really got to the area where I wanted to short it. We dropped off similar in reverse, meaning lots of weakness into the euro, and right where the target area was, we saw an accumulation of a long position and then a break, a hook, and a go higher. Okay, so headlines for this morning. Risk off, obviously, we had Asian equities in the red. Australia was weak. Nikkei was weak on strength of the yen. Shanghai, Hang Seng. The People's Bank of China fixed the renminbi weaker at 6.9154 midpoint, and we need to keep the magic 7 on the radar. We also this week have the currency report from the Treasury in the US. Goldman does not think that the US will coin the Chinese a currency manipulator. Nevertheless, we do have that on the radar. If that were to happen, the economic sanctions aren't really as strict as the tariffs are, but nevertheless, we need to keep this on the radar. If the 7 breaks here, that would be really, really bad. Brexit. PM May refused to endorse a draft that was worked out by the negotiators over the weekend, the Sunday night deadline. Twitter was full of first positive news and then negative news. Now both sides agree to pause in the discussion, and both sides are preparing for a potential no deal scenario. So this week, while we have important UK data, the pound will remain to be overshadowed by Brexit headlines. Cable tested 131 to the downside. We also saw dollar yen testing the 112 handle. Why? Because of yen strength. And the Dixie, i.e. the dollar index, rebounded off of 95 support. But we did see some weakness this morning in the dollar. Another thing that I want you to have on the radar is that Draghi stated last week that he currently sees European inflation around 1%, still thinks he is on target. We are on target in the EU to reach our target of 2%, but he sees risks to a deflation in asset prices and a sudden increase in rates. So we need to keep that on the radar. Sudden increase in rates would mean that credit risk is increasing within the system, and that is what he is wary of, rightfully so in my personal opinion. Also, the ECB stated that the ECB will not be there to help Italy. Hence, the market will continue to follow Italian headlines. The budget deadline for submission is today, and the spread between Italian 10-year and German 10-year is currently at 3.051, so about 3%. My expectation is that the market will test the 4% handle. This morning, mixed picture when I got to the desk. We did see this risk-off sentiment manifesting here in the yen strength, and then, interestingly enough, some US dollar weakness. Risk events for this week. Real quick. Let's do this together. Real quick. All right. So obviously this afternoon we have retail sales out of the US. Expected to come in better. I prepared a slide on that. We have the Bank of Canada Business Outlook Survey. That's going to be of importance to us. And out of New Zealand, we have better than last time expected CPI numbers, i.e. inflation numbers. Monetary policy meeting out of Australia overnight, and then Chinese inflation data. That's going to be of importance to the Aussie. We do have average earnings index out of the UK. That will be of keen interest to us if there is some inflationary pressure coming from wage growth. We also have unemployment rate and the claimant count change, which is a leading indicator, and that looks pretty positive over here. So UK economy in a positive scenario for now. We do have tick long-term purchasing data out of the US on Tuesday. Here, it will be of importance to us to have a look at if Japan and China are reducing their long-term purchases of US debt. That's going to be, see, this is no way is this a yellow event. This should be red or orange at least. Then on Wednesday, we have CPI data out of the UK. And we have, excuse me, Canadian building permits, housing starts, and manufacturing sales. The housing market is of interest in Canada to the Bank of Canada. That's why we're also having a look at this on Wednesday. And then obviously crude oil inventories. It's my payday on Wednesdays. Although last week the numbers came in on Thursday and wasn't as volatile as I would have wanted, but still made some money. It's okay. Thursday, we have employment change. I also prepared in Australia, I prepared a slide on that, and the unemployment rate. That's actually expected to tick down by the year end 2019 to 5%. So the employment situation is pretty solid over in Australia. We have retail sales out of the UK. That's expected to come in weaker. So towards the end of the week, a little bit of weakness expected fundamentally out of UK. We have the economic summit. Like I said, all discussions on Brexit on hold until the summit is over. And then on Friday, we have GDP data out of China, and that's going to be important for Aussie, obviously, but also the rest of the world, basically. We have Kuroda speaking. We have Canadian inflation data and retail sales. Did prepare a slide on that. And then we have Carney on Friday night. So without further ado, let's go into the slides and see where's our trade for this week. Okay. Dollar. We have retail sales expected to come in stronger, and core retail sales also expected to come in stronger. Don't know who of you saw this morning. Sears is one of the oldest retail stores in the US, filed for bankruptcy this morning. Or over the weekend, 125-year-old US retailer. I went shopping there quite a bit when I was younger. It's very amazing. Why? Billions of dollars of debt, and they will not be the only ones. As the rates are increasing in the US, you need to keep an eye on companies who over-leverage themselves, especially with variable rates, because that means that the cost of servicing the debt under an increased rate environment means higher costs, obviously, and there's some good short opportunities in the market as the equities look toppish here in mid-cycle or late cycle. Sorry, we are late cycle in the US. Analysts note that chain store sales have been rising in recent weeks while the labor market continues to improve. Yeah, that's correct. Beware, though, that we did see a disappointing University of Michigan Consumer Confidence Index on Friday. That is a leading indicator. And if and when an economy slows down, consumer confidence is one of the leading indicators telling us that, exactly that. In terms of the minutes that are expected later, please recall that during the September meeting, the Fed hiked by 25 basis points, put it right here on the chart for you guys as expected. And they also removed the word accommodative in their policy reference. The market did react dovish to the Fed. Why? Because they have what's called the dot plots. That means every member plots out where he or she sees the interest rate, the Fed funds rate in the future, and where they see the neutral rate. The neutral rate, guys, is the rate where a central bank does not interfere with an economy. So it's not stimulative, but it's also not restrictive. And the dot plots for 2021 saw rates anywhere between 3.25 to 3.5. And that matched the 2020 projection. And that way, inherently, they were hinting, so to speak, at a soft end date for their rating hike cycle. And that's why the market started reacting dovish to the Fed. The focus of the Fed is inflation, then the speed of economic growth, and the financial conditions index. So while they're hiking, the financial conditions are still accommodative. Their uncertainty factor, and they reverted us back to the beige book, is trade tensions. So meaning, if the Fed looks at inflation, we look at inflation. If the Fed looks at growth of GDP, we look at growth of GDP. If the Fed looks at financial conditions, we look at financial conditions. Good, just made some money in gold. Very nice while talking to you guys. Financial conditions are still accommodative. Meaning, if housing data comes out, that is not the focus of the Fed. That is why we, the professionals, are not focusing that much on housing market right now. So I want you to know what each individual central bank is looking at, because that are the drivers of the market for us to make money. On and onwards to the pound, the CPI, the inflation data, consumer price index, is expected to slip a tiny little bit, with the core reading to remain at 2.1 though. Please recall that last time the number surprised to the upside, came in at 2.7 versus 2.4. I put a picture for you guys on there. Why? We had unusually strong seasonal factors. But those factors are expected to drop out now. So our analysts at the banks are already preparing us for that. So a lower number is expected, meaning if it comes in lower, don't expect the pound to sell off. If it comes in super lower, then of course there'll be some follow through to the downside. Important here, there's such a thing that's called the quarterly inflation report. And if the CPI comes in as expected, then that would mean a 2.6% rate on average. And that is a little bit above what this QIR by the Bank of England suggested for August. So that is some upside potential there. Meaning, if it comes in higher CPI, then it's below what the Bank of England is calculating within their own model. And the market would then overreact and apply potential earlier rate hikes by the Bank of England, and the currency would react with strength immediately. Okay, hopefully I explained this in a good manner for you guys so you're tracking. Average earnings index is obviously important, because if labor starts costing more, that means pressure on the margins for companies, but also that's an inflationary pressure within the economy. And again, a central bank will hike rates if inflation were to increase and run away from them. We want inflation. Western central banks are aiming for a 2% inflation target, but we don't want inflation that is running away. So this average earnings index is expected to remain at 2.6, and the ex-bonus metrics is expected to match the prior 2.9. There's one large bank that is expecting a 3% for this one. Again, if that were to materialize, we could see some upside reaction in the pound. ING says, skill shortages across the economy are pushing employers to raise pay to attract and retain talent. That is the name of the game. That's why this number is important to us. Retail sales are expected to come in weaker than last time. Given the strength of sales growth over the summer, a moderation in September would be unsurprising. So a retail trader sees this number, comes in at minus 0.3. If he or she is uneducated, they would potentially short the pound whereas the pound would rally or go sideways or not react at all. Why? Because it's already priced in. This is the expectation. We need to see a large deviation from it to the up or downside for us to be able to make some money. Okay. Onwards to the Aussie, we have employment change expected to come in at 15.2 versus 44. The August data was so solid because we had 33.7 full-time jobs. So within the data, it's always important to look at full-time versus part-time. The more qualitative, better number is if we have full-time job additions. It's not as qualitatively solid if we have additions of part-time jobs. The annual jobs pace growth is unchanged at 2.5 year on year. The unemployment rate is seen remaining steady at 5.3. Participation, again, you need to look inside of the report to get to this number, is 65.7. If you see an increase in this number, that's bullish, a decrease is bearish. And then already we are expecting this number, unemployment rate, to tick towards 5% towards the end of next year. Yeah, so solid employment situation. The RBA minutes from the last meeting, we saw the RBA hold rates steady for the 24th straight meeting, and they did make no changes to their policy guidance. For the foreseeable future, no rate hike or rate hike action is expected. What is the RBA focusing on? They're focusing on low wage growth, on subdued CPI inflation, and on falling house prices. That's all disinflationary. And as long as we don't see any of these three or all three tick up, we cannot expect a potential rate hike getting priced in earlier by market professionals. I know that our job is really odd because today we're betting on things that may happen with the highest likelihood in 6 to 18 months. That is the name of our game. It's funny, right? So if CPI ticks up, if wage growth ticks up, if house prices tick up, then expect some strength in the Aussie dollar based on the assumption that the RBA will move earlier then. And I'm writing it out for you guys here. Currently, the market expects the first hike by the RBA in the first quarter of 2020, followed by another second hike in the second quarter of 2020. Again, if these three components were to tick higher, you can expect some strength in the Aussie because the Q1 and Q2 of 2020 would be moved forward. Betting on it today, on something that happens in 18 months down the road. You got to understand, this is an abstract game. It's like playing chess. You need to be 18 steps ahead of the opposition. All right. And last but not least, Canadian dollar, we have the business survey. It's a qualitative service, very important. But this one came out before the new NAFTA deal was announced. I know it's not called NAFTA any longer. It's called United States-Mexico-Canada Trade Deal. It's an updated version of NAFTA. But we expect that the bank did go back to the participants to get an updated color after the USMCA was put into place. And the focus by the Bank of Canada is on inflation expectations within the survey and capacity pressures. Because last time, business investment intentions and future sales growth expectations were moderated. So capacity utilization is important. If this ticks higher, then that means the economy is steaming ahead at full engine, meaning then a rate hike would be moved forward again, yeah, or solidified further. The Bank of Canada is expected to hike during the next meeting, I believe it is. CPI is expected to rise by 10 basis points and to tick to 2.6 year on year. Previous is 2.8. Why? Well, we're having higher oil prices. That's the main driver, but that's being countered by slowing wage growth and seasonal weakness in household activity after the summer. I think activity is misspelled. Apologies. Okay, so that's why we're taking a closer look at the CPI. It's an inflation number. Now, last but not least, Kiwi, again, CPI. Whoa, not 7 versus not 4. Why? Well, again, same story here. Higher oil prices. Weaker currency means I am importing inflation. My currency is weak, I'm importing inflation. And then the Auckland region passed the regional petrol tax. That's all inflationary. Housing related costs are also expected to have increased further in Q3. Okay, so this is good, solid. If it comes in much higher than 0.7, expect strength in the New Zealand dollar. The RBNZ is likely to look through the headline figure, though, and the expectation is for the bank to leave its rate unchanged until early 2020. So you have Aussie dollar, not expected to hike until early 2020. Same for the New Zealand dollar. And we have GDP and inflation data out of China this week, and that will lead the Aussie dollar. I cannot be clearer than I am currently. All right, on we go to, let's go please, commitment of traders. All right, Aussie on its way to a long signal. Yen on its way to a long signal. Kiwi on its way to a long signal. Volatility. Euro ticked down slightly. Pound ticked up significantly. That means if you're trading pound, please increase your stops. All right. Increased volatility means you need to give the currency more room to breathe in terms of your trading. Yen 778, slight uptick. Massive yen strength. Very solid for this week if the risk of sentiment remains. Have a look at anything where you can buy yen and short versus potentially the pound, for example. VIX also increased up higher this morning already. S&P 500 down. So good opportunities for us. Option pricing information from this morning. Bullish in the London session, euro dollar, euro pound, and gold. Gold already made my money. Bearish on Monday, London session, cable. Option flows indicating for us a bullish pound, yen, and gold. That means risk off, so to speak, and bearish Aussie, Canada, euro, and Swissy. Potential trade for this week. Don't be alarmed. I'm looking at longing gold. And that's quite funny because last time I recall, I said gold is not a long at all as long as the dollar strength continues. Now, finally, the short squeeze is on. The dollar is range bound to a little bit weaker around the Dixie 95 level. But what we're seeing is demand in gold. And that was interesting to me. So I need to trade what I see, not what I said last week. The risk of sentiment and a short positioning is an opportunity for a short squeeze to continue a bit higher. But in terms of the dollar, I need to be aware because we do expect good numbers this afternoon. So if there's some dollar strength this afternoon, that would be bad for the long gold situation. Gold could come off, maybe giving us a better re-entry price for the long. Besides that, for the rest of the week, sorry, hang on a second. Sorry, that's the squawk. Apologies. So clear selling for the dollar for the rest of the week. Risk to the trade, risk on and or dollar strength, naturally. Have a look at the chart. It's a classic flag trade for all of you technical analysts. We're seeing rising prices on increased volume. That's a good thing. Let me get the laser pointer out again. Okay. Then we have what we call a top right-hand hold and the same distance to the upside of this pole. Flag pole is an expectation of it to potentially work. Take profit could go all the way to 1250. I'm conservative, 1248 and a quarter. And the long situation on a slight retracement to the roll reversal around 1226 and a half, if it were to do exactly that. What's not so nice is that overall here in this reaccumulation situation, we did see, that's good. We did see an increase in volume right here. The breakthrough on not much volume also correct, but now I need to see volume to increase again. Let me take a look at my trade real quick. Yeah, okay. I'm not going to show that because it was a futures trade. Okay, cool. That concludes this morning meeting. Let me see if we have a question real quick. Nikkei now minus 215. Wow. Minus more or less. Hopefully you're long. Yes, I am long. Really enjoy the macro. What do you recommend in the way to learn the subject? Mick, potentially next week I will start training in English and then you can join the training program. Silver. Silver is less and risk on, risk off, as I'm currently playing in long. Silver is more of an economic metal, and the situation for silver is such that it's a mixed picture. The options are indicating on the short term a bearish bias, and on a longer term a bullish bias, VT. So that means we need to look at the GDP numbers out of China. If they were to beat this week, then that would indicate an expansionary global economy. increased demand, and then we would see copper, silver, industrial metals rising. But we're not seeing that currently. So I'm trying to bet on situations where I have a very high likelihood of making money. And that's why I'm preferring gold right now, because we are in a risk-off sentiment environment. Okay? Hope that answers your question. I'd like to say, as always, thank you for showing up on a Monday morning. Really appreciate you guys. And thanks to Admiral for the opportunity to do this for you. I wish you all an awesome week. Let's make some money, work on your trading, work on your psychology, and please stop taking bullshit trades. Learn this business, do what we do on the institutional side, and know exactly why a market is rising or falling. And a chart is never a reason to take a trade. With that, I said enough. Have a great week. Looking forward to seeing you guys next week. Thank you, and bye-bye.
Thank you very much, Jay, for your detailed analysis. I see our traders are very much liking what you have said, what you have told them, and you are getting compliments for your webinars. So thank you very much, dear traders, dear Jay. We are happy to see you again on Monday